Hello, and welcome to the webinar, Secure Act 2.0, Implications for Retirement Plan Sponsors and Employees. Before we jump into today's conversation, let's just review a few introductory details. We are recording this webinar, and the link to the recording will be sent to all registrants. You may submit questions or comments during the presentations in the questions section in the upper left-hand corner of your screen. If your question is not addressed in the content of the presentation, a retirement plan specialist will follow up with you to address your question. At the end of the webinar, you'll see a survey pop up before exiting. Please complete it as we greatly appreciate your feedback. Now I have the pleasure of introducing our speaker today, Fred Reich. Fred is a partner in the law firm of Fager, Drinker, Biddle, and Reith, LLP. His practice focuses on fiduciary responsibility, prohibited transaction, and plan qualification issues. He has been recognized as one of the legends of the retirement industry by both Plan Sponsor and Plan Advertiser magazines. He has also been given Lifetime Achievement Awards by Institutional Investor and Plan Sponsor publications, and received recognition by the IRS for his contributions to the retirement community. As a noted authority on retirement plans and plan management, Fred counsels plan sponsors, service providers, and registered investment advisors on fiduciary responsibility, prohibited transactions under federal law, federal audits, and pension plan disputes. Thank you, Fred, for joining us today.
Thank you, Mai. Well, let's jump right into this. On December 29th, the president signed a bill called the Consolidated Appropriations Act. That was over 4,000 pages long. Within that, there's a part called the Secure Act 2.0 that deals with retirement issues that was over 350 pages long and had over 90 provisions. Those provisions are going to affect almost everything that you can think about related to retirement. IRAs, 401k plans, 403b plans, pension plans. Obviously, we don't have time to go over 90 provisions today, so we're going to limit that to the ones that I think are really the most important to you all. As I talk about the different points, though, pay particular attention to a couple of things. One, did I say it was optional or mandatory? Optional meaning you don't have to do it, but you can if you want to. Mandatory, obviously, meaning you better do that on time or your plan's in trouble. Also, pay attention to the effective dates, because the effective dates on these different provisions extend out over the next 5-6 years. Some you want to be thinking about now, others in the future. Okay, with that admonition about how to listen to me, let's jump into the program by looking at the first substantive topic. That's on the next slide, which says, which talks about a new provision for mandatory automatic enrollment for retirement plans. This provision's a little odd, but let me tell you why in a minute. First, what does it do? Well, you'll see a lot of the slides and a lot of my comments today will be about for plan years beginning after such and such a date. In this case, December 31, 2024. I'm not going to do that every time. What that really means, since almost all 401k plans are calendar year, that really means in 2025. So in 2025, newly established, and I'm going to come back to those words newly established in a minute because it's a surprise. Newly established 401k and private sector 403b plans must, this is mandatory, must automatically enroll their eligible employees and provide for automatic annual deferral increases. The initial automatic enrollment rate has to be at least 3% of pay, but it can't be more than 10%. So let's say you start at 3%. Then every year after that it has to increase at least 1% per year. So 2025, 3%, 2026, 4%, 5% after that, and so on. It has to go up until at least 10%. But if you as an employer want it to increase up to 15% of pay, then you can provide that. employees have a choice. They can say, I don't want to be part of this. And nationally, roughly 10% of the employees opt out of automatic enrollment. Or they can change their deferral rate. So even though it's a mandate on employers, it's still optional on employees. If we go to the next slide, we'll see some additional details about it and get to the surprise that I mentioned. First, any defaulting participant has to be invested in a particular way. Well, what the heck is a defaulting participant? That's somebody who's automatically enrolled, but they never selected an investment. That means they defaulted. They have to be invested in what's called a qualified default investment alternative. Most of those are target date funds. That's what most plan sponsors pick. You can also be a managed account, or it can also be a balanced fund. As you can see from what I'm saying, it's a balanced allocation between equities and fixed income, but it has to be done in a particular way. And so you have to qualify for the QDIA. If you have any questions about that, talk to your plan advisor. They understand that at a level of great detail, and you don't need to worry about it. So you don't have to automatically enroll until 2025. But if your plan was established, was formed on or after December 29, 2022, a little over a month and a half ago, then it is a plan that has to ultimately automatically enroll. So if your 401k plan was set up before December 29, 2022, you don't have to automatically enroll, period. There's no law out there that says you ever have to automatically enroll. But if the plan was set up on or after December 29, you have to automatically enroll, but not until 2025. So that's the confusion. There are two effective dates. Who it applies to, December 29 of last year, when it has to happen, 2025 of this year. Now, if you want, and you have a new plan, that's the definition of new plan, December 29, 2022. If you want, you could automatically enroll now and be done with it, not worry about 2025. Or if you want, you could wait until 2025. So those are your options. And if we go to the next slide, there are several other little details that I want to talk to you about. First, there are some plans that this doesn't apply to at all. For example, government and church plans, new businesses. If your business has just been around for 3 years or less, you don't have to worry about this until you get to your 4th year. Then yes, it applies to you. Small businesses, do you have 10 or fewer employees? Then it doesn't apply to you. You don't have to automatically enroll if you don't want to. But when you go over 10 employees, yes, it will apply to you then if you're a new plan. That is a December 29, 2022 or later established plan. And then there are plans called MEPs and PEPs, multiple employer plans, and pooled employer plans. There were a bunch of companies get together and have a shared plan. They've become very popular in recent years. It doesn't apply to the MEP or the PEP as a whole, but if you join one, let's say right now, today, you were to join one, then you would be after December 29, 2022 as to your plan. And it, even though it's part of the PEP or the MEP, would have to automatically enroll. So this gives you a sense of how this will apply to you. But what if you're in the form before December 29, 2022? What does this mean to you? I think, and this is opinion, it's not the law or any rule. My opinion is that over the next 5 years, automatic enrolled plans will become the norm. They're already the norm for the largest 401k plans in America. But because of this rule change, that will be the way people will commonly think about plans because they produce much more success. I would say rough numbers, the average participation rate in automatically enrolled plans, 90%. The average participation rate nationally in regularly enrolled plans, 70%. That shows you that 70% of the people know how to get into a plan, 10% of the people know how to get out of a plan. The other 20% will go wherever they're put. If they're put in a plan, they'll stay there. If they're put out of the plan, that is if they have to elect to get in, they'll stay out. This is all about that 20% and about them accumulating benefits for retirement. So I think more and more pre-December 29, 2022 plans will voluntarily elect to become automatically enrolled because they'll want to have their plans appear to be, the normal way of doing business. So I think that could be in your future, even if you were before then. Okay, well, let's go to the next subject on the next slide, and we'll talk about an optional provision, matching contributions for student loans. If you're an employer that hires college graduates, you're a law firm, an accounting firm, a medical group, a technology firm, a pharmaceutical company, anybody who hires lots of college graduates, this should interest you. Not this year, but next year, 2024, you can begin at your discretion to say to your employees, we will match your student loan payments. There's a new term, QSLIPs, qualified student loan repayments. You can match them under your regular matching formula. So if an employee pays $1,000 against student loan repayments, and you match at 3%, then you could put in $30 as a matching contribution for them. So that's a new provision that would be particularly attractive to employers who hire a lot of college graduates. You can rely on the employee's certification that they made those payments. You don't have to investigate, so it's easy. The match has to be the same as for basic employee participant deferrals, so it just becomes part of your program. Obviously, you have to coordinate with your record keeper to make sure first they're capable of doing this, and secondly, that they have communication materials and forms and the likes that you can use to provide your employees. And then the discrimination testing will be done easily. One way or another, I can't imagine you wouldn't pass the discrimination test for this because you've got some options about how to do it. So what does this mean to you? Let's say you're one of these employers that I'm talking about. Somewhere between now and maybe August, September at the latest, I think you have to make a decision about whether or not you're going to do this, because it's the nature of 401k plans that they start operating in a particular way on January 1. So January 1, 2024, you want to be up and running. So let's say July, August, working with your advisor, you make a decision, yes, we're going to do this. And you coordinate with your record keeper. Your record keeper says, yes, we can do it. Here are the forms. Here are the communication materials for your employees. Here's how they can certify contributions. Here's what you as an employer need to do. And you get that. Then beginning in November, probably at the latest, you want to be providing those education materials to your participants, to your employees, so that they know that this is available to them beginning January 1, 2024. So that's what I see ahead of you if you're one of these employers. But what if you're not? If we go to the next slide, I've got something for a different group of employers. Beginning in 2024, also, plans, defined contribution plans, 401k plans, can set up what are called pension-linked emergency savings accounts. This will probably be the last time you ever hear that term the way I just said it. That's what the law calls it. People are calling it either emergency savings accounts or sidecar savings accounts. That's the language that's developing around this. It's just for non-highly compensated employees, and you actually have a savings account associated with your plan, and deferrals can be made into these savings accounts. They can only accept employee deferrals, and they're all Roth treated. That means they're taxed through to the employee, but when they pull the money out, it's tax-free. So if you want, and I have a hard time, although you may not, I have a hard time thinking that an employer would want to automatically enroll employees in this. Maybe they will, but in any event, there's a rule. You can't, they can, if you automatically enroll employees in the savings account, the contributions cannot exceed 3% of pay. There's a cap. Again, you're going to have to coordinate with a record keeper to make sure they can provide you with education materials, forms, and so on. And you're going to have to make decisions about this. You're sort of in that same July or August, you ought to be talking about it. August, September, you ought to be making decisions about it. October at the latest, coordinating with your record keeper. November, be distributing materials, and so on. But this is the longest single provision, and in my mind, the most complex, well, one of the two most complex provisions in Secure Act 2.0. If we go to the next slide, I can explain some of the complexities. The total amount contributed by a participant to the savings account, the sidecar savings account, cannot exceed $2,500. That'll be adjusted in the years ahead. And if you want a lower amount, you could put a lower amount in your plan. I think most people would just say $2,500. That's just the contributions. If there's earnings, the account can go above that, but the contributions cannot exceed $2,500. And they're treated as elective deferrals, so you have to match them, subject to the same limit. The matching contributions don't go into the savings account, though. They go into the matching account inside the plan. So the withdrawal rules that I'm going to talk about in a minute don't apply to the matching contributions. They only apply to the deferred savings contributions. So going to the next slide, we'll see more detail. You have to allow withdrawals at least once a month from the sidecar savings account. There can be no charges for the first 4 withdrawals in a plan year. For any withdrawals in excess of 4, there can be a reasonable charge. Some of this will be handled for you by the record keepers, by your plan providers. So while I'm making this sound burdensome, which I think it will be to a degree, I don't think it'll be as burdensome as it might feel like right now, because the record keepers are going to have to step up and make this work for you. And the withdrawals will be treated as best as we can tell, even though the rules aren't specific enough, detailed enough, the same as any Roth accounts, which is in the first 5 years, any money that goes in can be withdrawn tax-free because it was taxed through to the participant. Any earnings that are pulled out would be taxable to the participants for the first 5 years. After that, they would not. By the way, if withdrawals are made so that the total contributions of $2,500 is reduced, let's say, to $2,000, then another $500 can go in because they can get their total savings contributions back up to $2,500. That's a cap, but it can be refilled after withdrawals are made. Why do we have this rule? Mainly because so many people were laid off, I think, in the pandemic. They had trouble paying rent, they had trouble buying food, just the terrible, terrible stories that we heard in the pandemic, and people not having savings. So the idea is to encourage savings. And on the next slide, the money has to be invested in a savings account, or it can be invested in something similar to a savings account, like a guaranteed income contract in the plan or a stable value account in the plan. But it's not going to be invested in securities or bonds or that sort of thing. It's going to have stable principal value plus interest. The law specifies the disclosures that have to be given to participants. You don't have to worry about that. And the law also preempts any state laws that might conflict. One more slide on emergency savings accounts. As I said, it's the longest provision in the law. So let's go to the next slide. If you decide to terminate the account, or if the participant quits, they leave, they can either transfer it to another Roth account. If your plan authors Roth accounts, it can go to their Roth account in the plan, the savings account, any unused balance, or if not, it'll be transferred to the participant. So who is this right for? It seems to me that if you have primarily a blue collar workforce, maybe you're in construction, you're in the restaurant business, but you primarily have a blue collar workforce. So you don't have a lot of college graduates. You don't have to worry about that student loan provision, but you do have people who may not make a lot of money and who may not have savings, and you want to help them out in case bad times come again, which inevitably they will someday. This is a way to do that. So talk to your advisor somewhere by the middle, July, August, and start talking with your record keeper if you're interested in this. Because as you might imagine, this thing is a lot of work to record keep, and you can rely on your plan administrator to do that. You don't have to do that. Okay, enough about sidecar savings accounts. Let's go to the next slide. We're back to a new plan, concept of a new plan. So if you already have a plan, you might be interested in this, but it's really focused on new plans. There are some incredible credits for the startup costs for plans. Beginning this year, so this is already in effect, if an employer puts in a new plan, they get a credit for 100% of the administrative costs for up to 50 employees, with a phase out of 2% per employee between 51 and 100 employees. So think about it, a credit of all of the administrative costs. There's a formula in there, but if you have at least 20 employees, it's all of the administrative costs. But you get a credit that gives you back what you paid for administration of the plan. For the first 2 years, it's 100%, 75% the third year, 50% the fourth year, 25% the fifth year, and then no credit after that. But for the first 2 years, all of your administrative costs for setting up and operating the plan are fully offset up to $5,000. After that, substantially offset for the next 3 years. And then after that, you're on your own. This is to encourage employers to put in new plans. And the real missing part of coverage in America is that small employers, which are defined here as under 100, but particularly under 50, don't have retirement plans. And this is an effort to get them to do it by substantially reducing the cost for this first several years. But it's better than it even looks. If we go to the next slide, you can see there's another credit, a credit for a 100% credit for contributions to employees that make $100,000 a year or less, up to $1,000. For example, you could design a plan that says, I'm going to put in $1,000 for every one of my employees who make $100,000 a year or less. And the government will give you that back. So if you have 20 employees, $20,000, you'll get a tax credit for $20,000. So it's free. So you can put for free in the first year, free in the second year, 75% paid for in the third year by the government, 50% in the fourth, 25% in the fifth, and so on. That's up to 50 employees, and then it prorates down between 51 and 100. I'll be honest with you, I have never seen credits this good anywhere associated with retirement plans. So if you or someone you know is thinking about setting up a plan, this is an optimal time to do it and design the plan and set it up so that you get the full benefit of this, of these credits. One more slide on this and we'll finish with this subject. I would also say this applies to qualified retirement plans, you know, a 401k plan, a profit sharing plan. It also applies to simple IRA arrangements and a SEP IRA arrangement. So it's pretty darn flexible. And if you join, rather than setting up your own individual plan, you join a pooled employer plan or a multiple employer plan, you also get the credits. That's the same thing you get as setting up your own plan in terms of getting these credits. In addition, for the first several years, there's a $500 a year credit because the plans are automatically enrolled. That's on top of everything I told you about on the 2 slides preceding this one. So it now is a great time to set up a new plan. Okay, let's go on to the next subject. By the way, that was optional. If it wasn't obvious that those credits, you don't set up a plan, you don't get them. You set up a plan. If you want them, you can get them. There's an increase for required minimum distributions. It used to be for many, many, many years, after you turned 70 and a half, you had to start taking out required minimum distributions from IRAs and in most cases plans. Then the Secure Act, well, I'll call Secure Act 1.0, the Secure Act from 2019, increased that to 72. Beginning in this year, 2023, it is now 73. So if you turn 72 in 2022, you're stuck with a 72 age. But if you turn 73 in 2023, then this year or later becomes your age for starting required minimum distributions. Similarly, for a person who attains age 74 after December 31, 2032, or in other words, in 2033, it's increased to 75. Some of this is to take into account the fact that people are working longer. I think it's particularly true of white collar jobs that folks are working longer and they've been forced to take out minimum required distributions on top of their regular earnings. So that's forced it into a high income tax bracket. The money isn't really being preserved for retirement. It's being used while people are still working. So this is to take into account the longer life expectancies and the later retirements. So, and remember, even though we're mainly talking about retirement plans today, this applies to IRAs as well. Okay, going on to the next subject and the next slide. Beginning in 2025, there can be additional catch-up deferrals. I'm not keen on this rule because I think it's too complicated and confusing. But for participants, and again, this is until 2025, keep that in mind. For participants age 60, 61, 62, or 63, during those 4 years, you can put in 50% more than what the regular catch-up contribution is. So, for example, catch-up contribution in 2021 was $6,500. If you add 3,250 on top of that, it gets you to 9,750, in which case you can take out the larger amount, $10,000. But by the time we get to 2025, cost of living will increase that $6,500 limit so that 150% is well beyond 10,000. So that'll in effect be the amount that you can put in. So you can put in the regular amount plus another 50%, but only for those 4 years. So you can imagine educating employees on it. At 59, you can't do it. At 64, you can't do it. But 60, 61, 62, 63, you can do it. I don't know. I don't know what you all think. I just think that's kind of messy. I wish they had just said beginning at age 60, you could do it as long as you were working. And maybe they'll get to that at some point. But anyway, that's a matter of opinion. You may see it differently than I do. I'm glad extra money can be put away by older workers after their children are grown up, maybe their house is paid off, after college expenses are paid. Maybe they'll have that extra money in some of their higher income older years where they can actually save more for retirement. So I'm not against it as a concept. I just think they did it in a really confusing way. Okay, on to the next slide. There's a new rule that employer contributions now, this is effective now, can be made as Roth contributions. It's an option to the employer. So what does all that mean? It means if you as an employer say, I want to give my participants, my employees, the ability to select, to decide whether they're going to receive the matching contributions and any profit sharing contributions that I make as Roth rather than as pre-tax. Then I can give them that election and they can decide what they want to do. So they could say, give me the matching contributions as Roth, but not the employer profit sharing contributions. You can design that program. There's only one glitch. That is, you can only do it with fully vested contributions. So if you have a vesting schedule in your plan, you can't do it because it has to be fully vested, which makes sense because the employees are going to be taxed on it. So what do? Or let's say your matching contributions are fully vested, but your profit sharing contributions are not. Then you could do Roth for matching, but you couldn't do it for the other employer contributions. Who's this going to be attractive to? I think we're back to that student loan type employer. This is a pretty complicated issue. For example, Roth contributions make sense when you're younger and in lower income tax brackets. They may not make sense when you're older and you're in a higher income tax bracket. So you want the money going in to be in a lower income tax bracket than when you take it out in retirement. That's when Roth has the greatest effect, the greatest benefit. So what about a blue collar workforce? This is awfully complicated. I would be concerned it would be difficult to make good decisions. On the other hand, they're probably in really low income tax brackets. So it could make sense in that sense. So I think it's important for plan sponsors to meet with their advisors to understand this provision and to make a decision about how to do it, then go talk to the record keeper and see if they can record keep it. I will tell you, this was in the bill on December 29. It became effective January 1 in effect because 401k plans are on a plan year. I don't know any record keepers, although there may be some that in that 2 or 3 day period could get all their systems set up to handle this. So I think they're working on it. Even though this is effective now, I would, for practical reasons, regard it as a January 1, 2024 option because there's some work to be done to get to that point. Roth plan distribution rules. I don't know if you all realized it, but if you have a Roth IRA, you don't have to take required minimum distributions, period. As long as you're alive, you don't have to take them. Your beneficiaries may, but you don't. Roth accounts inside 401k plans, inside qualified plans, did not have the same benefit of that. They did the required minimum distribution rules applied to them. No more, or at least no more beginning January 1 of next year. The required minimum distribution rules beginning next year will not apply to Roth accounts inside retirement plans. Okay, let's go to the next slide. There is a new provision that says beginning again in 2024, catch-up contributions have to be treated as Roth contributions for employees that make more than $145,000 a year, which will be indexed in the future for cost of living. So any employee of yours that is old enough to make a catch-up contribution, either the regular one or that enhanced one we talked about, beginning next year will have to receive that as Roth, meaning they're going to be taxed on it. It'll go into their account. If it stays in there for 5 years, or if they've already had a Roth account for 5 years, they can pull the whole amount out. They can always pull the principal out tax-free because they've already paid taxes on it. But they can also pull the earnings out tax-free once the 5-year requirement is met. So, but there's no choice. This is mandatory. There's no election to the employer or the employee. This has to happen starting next year. Obviously, your higher compensated employees should be aware of this because they may not want to do Roth, or they may have reasons. I mean, one reason possibly is it may not make a lot of sense to do Roth in your highest income tax years when you're going to retire in a few years and your income tax bracket will drop down. So there needs to be some education and information to the higher paid employees. Simple and SEP IRAs can also have Roths beginning this year. So if you have a simple IRA plan or a SEP IRA plan, employees can set up Roth accounts, Roth IRAs, and tell you to put the money in there. Now let me give you a little bit of a warning on that. There is some confusion in the law. There are some organizations that represent plan sponsors that are writing to Congress and to the IRS saying, give us some guidance on this because we can't tell if the employer has an election to do it and then they can let the employee do it, or if this is totally in the control of the employee and they just tell the employer has to do it. So this one's a little dicey because the way the law was written is not entirely clear. If an employee comes to you and says they want your simple or your SEP IRA program to treat them as Roth, talk to your attorney or your advisor. Try to get an answer on that because I think within the months ahead, we will get answers on some of these unknown questions. Okay, enough about that. Let's go to the next. Again, for new employers who do not have a plan, there's a very simple new plan design called a starter 401k plan. A starter 401k plan is deferral only. You can't put any money into it. The employer cannot put money in. If you want to put money in, start a regular 401k or join a PEP. But if you don't have the cash flow, if you're a young company, but you want to have something for your employees to defer into, or if you're going to be forced into an IRA-based deferral payroll withholding plan by the state in which your company is situated, this is a great option. It's a starter 401k plan. It doesn't become effective until next year, but it's a deferral only. You have to defer at least to 3%. You can't set it any higher than 15%. The maximum is $6,000 a year for deferrals, which is the IRA limit, and another 1,000 on top of that beginning at age 50 for regular catch-up contributions. So again, this is to encourage plan coverage, even for very small, very new companies that may not have enough cash flow to make a real commitment to make employee contributions. Okay, next slide. I've mentioned pooled employer plans a couple times. A pooled employer plan is where a financial institution can say to the world at large, to all companies in America, hey, you can join our plan and you'll have your own plan, but all the assets are together. Hopefully we've got lower cost investments. We've got fiduciary diligence. We can provide administrative services cost effectively, and we'll take a bunch of the administrative and fiduciary responsibility off your back. That's a PEP, a pooled employer plan. That would be like, for example, for a 401k plan. That was in Secure 1.0 back in 2019. This bill brought in the same thing, a PEP or a MEP for 403b plans. So who should be interested in this? If you're like on the board of a small private school or a tax exempt charity, and you're not so big that you would really want to sponsor your own plan and deal with the complexity of that, maybe the cost, maybe you're thinly staffed, so you really aren't well suited for the extra administrative work, then this PEP for 403b plan for 403b plans would be a great deal for you. They're brand new. These became effective this year, January 1, weeks ago. As a result, providers aren't really fully set up to deal with this yet, but they're working on it. So again, talk to your advisor. Your advisor can help you find a provider. But if it's for a tax exempt or a private school, and this could be really optimal for that organization. And I'm pretty sure that most tax exempts, most charities, and most private schools aren't aware of this yet. So you could convey that information to them through your service for that organization. Okay, this applies to everybody. That last one was optional. This one is mandatory. Long-term part-time employees. The 2019 Secure Act said, if you have an employee who works for you between 500 and 999 hours a year for 3 consecutive years, that is part-time, 500 to 99. In ERISA, in their pension laws, 1,000 hours is full-time. So 500 to 999, 3 consecutive years, you have to include them in your 401k plan. Have to, but only for deferrals. You don't have to make employee contributions. So that rule started counting in 2021. So you have 2021, 2022, 2023. You have to bring those people in on January 1, 2024. If you haven't been counting hours for your part-time employees, you better start doing it, because this applies to you in January, next January, 11 months from now. So Secure Act 2.0 said, wait a second, we're going to reduce that 3-year to 2 years, but it won't apply till 2025. So for 2024, 3 years, long-term part-time. For 2025, 2 years, and after 2025 and thereafter, 2 years, long-term part-time, have to be included for deferrals only. Now, you as an employer, for next year, because of the 3-year rule and the original Secure Act, are going to have to decide, are you going to match those? No legal requirement. It's your choice. But are you going to say, hey, these are valuable employees, they've been with us long enough that I want to treat them like they're real employees? Or do I want to run the risk that they'll feel like they're, not full citizens, full members of the company community? That's a choice. And it depends on the culture of your company. It depends on how you regard these employees, but it's one you should make and really need to make. Again, that should be in place by January 1, 2024 for the 3-year rule. So be talking to your advisor and be making decisions about how you want your plan to operate vis-a-vis long-term part-time employees. Let's go to some other just provisions that you need to know about and as a part of this. Plan amendments. I mean, anytime there's plan changes in the law, you should know ultimately you're going to have to amend your plan. Well, but you don't have to amend it till 2025. That leaves you with some issues. Every one of the mandatory provisions that I've mentioned have to be implemented on the effective dates that I told you about. They have to be. That's because they're mandatory. And you have to operate them in accordance with all the legal rules surrounding that mandatory provision. But you don't have a plan document that lays that out. How do you do that? Well, you're going to have to work with your advisor and your record keeper to first understand which ones are mandatory and when they come into effect. And then secondly, how we can implement those on a timely basis. Then when you get out to 2025, you're going to have to amend your plan retroactively to cover 2023, 2024, and 2025. Now, what about the optional provisions? The optional provisions, you could say, hey, I'm not going to adopt any of them if you want. I'm not going to do student loans. I'm not going to do sidecar savings. I'm not going to do any of those. And that's okay because they're optional. But let's say you say, no, I want to do beginning January 1, 2024, I'm going to do the student loan matching contributions because I hire a lot of college graduates and I want them to know that I understand the issues in their life and I'm going to help them. If that's your philosophy, then you'll probably adopt that provision in 2024 and you have to satisfy all the rules in 2024, even though in 2025 you're going to amend back to say, hey, here are all the rules. So again, that's not something a plan sponsor should do by themselves because I'm talking about the rules from a relatively big picture perspective, even though it may seem like I'm dragging you down into the weeds. There are more weeds than we can talk about today. So somebody's going to have to help you with that. And your advisor and your record keeper, your provider, they're the people that are really there for you to help you out with this. Enough about that. Hardship self-certification. A new provision just says, hey, employees can self-certify hardship withdrawals. So there'll be a form, I'm sure your record keeper will design one and give it to you. You have the employee sign it, and then you can make the hardship distribution without doing anything else to determine whether they're really eligible for it. So that's good. That reduces your administrative responsibility and your administrative risk. That's a good provision. Obviously, it's optional, but you will want to take advantage of it. Now on the next slide, mandatory distributions. You know, right now, if an employee leaves and you ask them to make an election to withdraw the money to take or to roll it over, and their account is 5,000 or less, and they don't respond, you can force that out into a rollover IRA. That's increased to $7,000 in 2024. So that's just recognizes that, you know, with the stock markets and times going by, you need a higher limit. There's also, this is one of the things that's the furthest out there, a savers match. And it's incredibly detailed, so I'm not going to get into it very much. It becomes effective in 2027. But for low and middle income people who put money into IRAs or retirement plans, the government will put in a match of 50% of that contribution, up to $2,000. Well, think about that. The federal treasury is going to have to get information from you and those participants, from the participants about whether or not they made the contribution, from you about where their account is so that they can put it into that. Now, realistically, that'll probably be the record keeper, but it's still going to involve some additional reporting. I think this is the single most complicated provision to implement. Fortunately, in the whole law, but fortunately, the federal government's going to have to figure out how to implement it. You won't. Okay, let's go to the next slide. And as we approach the last slide and the end of the program, let me just say that the Act directs the development of a retirement savings lost and found within the Department of Labor. It's not real money. It is a searchable database. So the money isn't there, but a database where participants can go look and see if they left money behind. For example, did they work for you 8 years ago? They left but they left their money in the account. And that happens a lot. I don't know if you all realize how much it happens, but I recently helped a plan terminate, plan with maybe a couple thousand participants. They had over 100 of these participants who had left their money behind. So that means you're going to have to report, the government's going to have to revise its forms so that you can report where a participant has left and still their money is still in the plan. They're no longer working for you, but they haven't taken a distribution. As a result, you're going to have to report that to the government. That information will go into the searchable database. And 10 years from now, that participant could contact you and say, hey, I want my money. And you would have to distribute it to them. I think this is, this is a difficult position to be in. I think my response, again, on a practical level, is I would redouble my efforts to communicate with people who no longer work for me, but still have account balances, to take their distributions. I've been in a position where somebody's come back 8 or 10 years later, and it's hard to find records. It's just difficult to determine whether or not they really did take their distribution, but they took it a couple of years after they left rather than the year they left. You can imagine. So my response to this, if I were you, is I would really make a much stronger effort to make sure that people have the fullest possible opportunity to take their money with them. And then finally, I just want to comment, there's a lot of focus on 403B plans generally. The goal is to bring lower cost investments, better services, and the like to 403B plans. You can look for more of that in the future. Okay, I know I have run you all through a lot today. That's because of the nature of this bill. It is structured with multiple effective dates, with over 90 provisions, with optional versus mandatory. There's really no way to talk about it without getting down into the weeds. There's no real theme that ties all of these together. It's some of this and some of that. And the only way to understand it is to put the jigsaw puzzle together. So hopefully I've given you pieces that are an introduction to you to some of these issues, that have whetted your appetite about some of the optional provisions, that have alerted you to some of the mandatory provisions. And then the next step is on you to work with your advisor and to work with your provider to figure out what you need to do to comply and which of these optional provisions are right for you and your company. Thanks for spending time with me today. Mai?
On behalf of Hub International, thank you for attending today's webinar. As a reminder, we ask that you please fill out the exit survey before you close your browser. Your feedback helps us as we develop future webinars. That now concludes our broadcast. Thank you and have a great rest of your day.